how confidence quietly collapsed. It didn't shatter in a moment. It thinned, slowly, almost politely. Confidence didn't disappear. It leaked away unnoticed until the system realized it was gone. This story matters now because confidence is the invisible currency of markets. Prices, liquidity, and stability depend on it more than any policy or model. When confidence erodes quietly, markets don't scream warnings. They drift into vulnerability. To understand how belief can vanish without panic, we need to return to the moment confidence began slipping through the cracks. It started during a period of apparent strength. Earnings were solid. Growth was steady. Volatility remained contained. On the surface, everything suggested resilience. But beneath that calm, behavior began to change in subtle ways that data alone couldn't explain. Institutions became cautious without announcing it. Exposure was trimmed at the margins. Position sizes stopped growing. New commitments required more justification than before. No one called it fear. They called it discipline. But discipline has a tone, and the tone was shifting. The early reveal appeared in liquidity. Not disappearance, but hesitation. Orders took longer to fill. Depth thinned slightly at critical levels. Market makers adjusted spreads just enough to protect themselves. These weren't disruptions. They were adjustments. Quiet ones. Confidence doesn't collapse when bad news arrives. It collapses when good news stops being believed. That moment arrived when strong data produced weak reactions. Earnings surprised positively, yet rallies stalled. Economic optimism failed to ignite momentum. The market absorbed good news without enthusiasm, as if it no longer trusted its own story. Those watching closely understood what this meant. Confidence isn't binary. It fades, and once it begins fading, recovery becomes harder than collapse. The system hadn't broken, but belief was slipping. And belief, once questioned, rarely returns without a test. The collapse of confidence wasn't dramatic. It was discreet, and it was already reshaping the market. As confidence thinned, behavior adjusted further. Traders shortened time horizons. Investors favored liquidity over return. Cash positions crept higher, not because of fear, but because of hesitation. The system was preparing without admitting it needed to. The reveal deepened when correlations shifted. Assets that once moved independently began drifting together during minor stress. Diversification weakened quietly. Hedges underperformed. The market wasn't panicking, but it was losing its natural shock absorbers. The early conflict emerged in funding markets. Costs edged higher without explanation. Terms tightened. Rollovers required more effort. These weren't signs of crisis. They were signals of doubt. Counterparties were still willing to lend, but only cautiously and not for long. Narratives tried to keep pace. Analysts spoke of consolidation, digestion, healthy pullbacks. But the language lacked conviction. Confidence couldn't be argued back into existence. It had to be felt, and it wasn't. Institutions noticed a shift before the public did. Risk committees met more often. Stress tests were expanded. Scenarios once labeled improbable were reconsidered. Exposure wasn't cut aggressively, but it was capped. Growth and risk had stopped. The market continued functioning. Prices moved. Trades cleared. But beneath the surface, something essential was missing. The willingness to commit, to lean forward, to assume tomorrow would look like today. That assumption had quietly expired. The system wasn't reacting to events anymore. It was reacting to uncertainty itself. And uncertainty, once internalized, becomes self-reinforcing. The collapse of confidence was not an event. It was a process, and it was accelerating. The tension reached a breaking build when the market finally encountered stress without a cushion of belief. A routine disruption, minor, explainable, manageable, arrived at the wrong moment. In the past, confidence would have absorbed it. This time, it didn't. The conflict intensified as participants reacted faster than reason, not out of panic, but out of mistrust. Positions were reduced preemptively. Liquidity was withdrawn defensively. Every action assumed the next participant would act the same way. And they did. Volatility rose sharply, not because of magnitude, but because of fragility. Small moves created outsized reactions. Stops were triggered earlier. Models adjusted aggressively. What once required confirmation now required only suspicion. Funding markets felt the strain immediately. Short-term lending tightened further. Counterparties demanded higher quality collateral. Overnight assumptions no longer felt safe. The system began operating on shorter trust cycles, hours instead of days. This was a critical shift. Confidence hadn't just weakened, it had inverted. Participants no longer assumed stability until proven otherwise. They assumed risk until proven safe. That reversal changed everything. Trades were exited faster than they were entered. Hedging became mandatory. Optionality replaced conviction. The market became reflexive. Each defensive move validated the next. Selling confirmed doubt. Doubt justified selling. There was no single trigger point to, only behavior feeding behavior. By the time headlines caught up, the damage was already embedded. Prices reflected not fear of loss, but absence of belief. The system hadn't failed. It had lost faith in itself. And once that happens, recovery requires more than reassurance. It requires proof. The collapse of confidence had crossed its most dangerous threshold, from quiet erosion to active retreat. The climax arrived when the market finally acknowledged what had been avoiding. Confidence wasn't coming back on its own. The quiet erosion had reached a point where reassurance no longer worked. Words lost power. Promises sounded hollow. Only action mattered now. Prices stabilized briefly, then slipped again. Not violently, persistently. The kind of movement that drains conviction rather than shocks it. Buyers stepped in cautiously, only to step back just as quickly. Liquidity appeared, then vanished. The market was searching for belief, and finding none. The resolution unfolded slowly, through demonstration rather than declaration. Balance sheets were strengthened. Exposure was reduced until resilience returned. Time passed without disaster. Gradually, trust began to rebuild, not because optimism returned, but because survival was proven. Confidence didn't rebound to old levels. It reset. Participants learned a harder lesson about belief, that it cannot be engineered, that it cannot be demanded, that it must be earned repeatedly through consistency and restraint. Markets remembered how fragile confidence truly is, and how quietly it can disappear. Modern relevance is everywhere. Today's markets still run on belief, still depend on trust between participants who may never meet, and still underestimate how easily that trust can erode when behavior shifts before narratives do. The collapse of confidence didn't announce itself. It revealed itself, and those who recognized it early weren't the loudest. They were the ones who noticed the silence. Sometimes the smallest shift in perspective becomes the beginning of a new future.